What's up, guys? This is the network back with another video, and today we are talking about one of the most powerful financial tools that most people have never even heard of. We're breaking down the non-grantor, irrevocable, discretionary, complex, spendthrift trust, how it works, how it protects your assets, how it builds generational wealth, and how the elites have been using this exact system for centuries, while the average person was never taught any of this. Now, this video is for educational purposes only. And if you want help setting up strategies like this, contact the network directly on Discord. Telegram is no longer reliable for any of our private client work. Let's get into it. So first, we got to start with a little bit of history to really understand where all this comes from. The trust system didn't just show up recently. This structure has existed for nearly 500 years. Originally, these trusts were created as a response to oppressive governments who were seizing land and property under the excuse of taxation. Landowners developed trust systems to separate ownership from control and protect their assets from being confiscated. That same core idea evolved into the legal trust structures we're talking about today, specifically the non-grantor, irrevocable, discretionary, complex, spendthrift trust. Now let's break down what that even means, because that's a mouthful, but every word in that name has very specific legal power behind it. First, the non-grantor part, that means that the person who creates the trust, also known as the settlor, does not retain ownership or control over the assets once they're placed into the trust. When income is generated from those trust assets, it's not taxed to the grantor, it's taxed to the trust or to the beneficiaries. This removes the grantor's personal liability and creates massive tax planning opportunities that we'll get into later. The irrevocable part means that once you put assets into the trust, they cannot be pulled back or changed by the grantor. That locks in the asset protection because the assets are no longer yours. They're now controlled by the trust structure itself. No court, no creditor, no lawsuit can easily reach assets that you no longer legally own. The complex part refers to the fact that the trust can accumulate income, unlike simple trusts, which have to distribute income immediately. Complex trusts have the flexibility to hold income, reinvest it, and allow it to grow tax deferred as long as the income remains in the trust corpus. The discretionary part gives full power to the trustee to decide how much income, if any, is distributed to beneficiaries, and when this allows the trustee to manage tax liabilities, manage distributions, and keep wealth protected without triggering unnecessary taxable events. The spendthrift provision is the layer that protects the trust from creditors, lawsuits, divorces, and bad financial decisions by beneficiaries. Even if one of the beneficiaries gets into financial trouble or legal issues, the trust assets are protected because they legally cannot demand distributions on their own. The trustee has full discretion on what gets paid out, if anything at all. When you combine all these elements, you create a structure that is legally bulletproof for asset protection, estate planning, and generational wealth building. Now, I want to make sure you understand something important, because a lot of people, especially on the internet, misrepresent these trusts. This is not some loophole that allows you to pay zero taxes forever. This is not some sovereign citizen fantasy. This is 100% legal and fully recognized by U.S. law, especially when managed properly under contract law and common law. Now let's talk about how this structure came into the U.S. system. When the trust model arrived in America, it had to adapt to U.S. tax codes, especially once the IRS was created in the early 20th century. That's when provisions like IRS Code 643 came into play. 643 allows the trust to defer taxes on certain passive income and extraordinary dividends. Now notice I said passive income. We'll come back to that because it's critical. This trust can't completely avoid taxes, but what it can do is defer taxation on passive income sources, which allows for massive compounding growth over time. We're talking about rental income, dividend income, capital gains income, life insurance proceeds, and similar passive revenue streams. What it cannot defer is active income, meaning wages, commissions, or day-to-day business revenue. But there are legal strategies to convert active income into passive income using LLC partnerships and joint ventures where the trust is structured as a limited partner, and we'll touch on that more in a minute. This brings us into the true wealth building strategies that the elite have been using with these trusts for decades, possibly even centuries. One of the most powerful combinations is when you pair this trust with properly designed whole life insurance policies, especially modified endowment contracts or MECs. When structured correctly, the trust owns the policy, is the payer, and the beneficiary. And because of that ownership structure, certain MEC limitations do not apply the way they do for individuals. Whole life policies grow tax deferred, provide guaranteed death benefits, and create accessible cash value that the trust can borrow against at any time without triggering taxable events. This gives you liquidity without selling assets, and without paying taxes on withdrawals. You're borrowing against yourself at simple interest, not compounding interest like with banks and credit cards. To really understand how powerful this is, let's walk through a simple example. Imagine you build your business, you start funneling a portion of your profits into the trust through legal deferred income mechanisms. The trust uses that income to purchase high-value whole life policies on each of your family members. Over the years, those policies grow in value. Every time a family member passes, the trust receives the death benefit, which replenishes and grows the trust corpus exponentially. Every generation, the trust wealth increases larger and larger because of the compounding effect of multiple policies over multiple lives while still maintaining control and asset protection. This is literally how families like the Rockefellers, the Morgans, and others have built massive dynasties that last for centuries, while the average person was never taught any of this because they were sold on chasing taxable W-2 income buying liabilities and staying trapped in the system through ownership instead of control. The most dangerous lie we've been sold is that you need to own everything in your personal name: house, cars, business assets, retirement accounts. But with ownership comes exposure, liability taxes, lawsuits, and government regulation. The trust structure allows you to control everything while legally owning nothing in your personal name. Now let's go even deeper, because some of you want to know how this applies to business ownership and income. When you place your business assets inside the trust, you shield them from personal lawsuits and liabilities. If somebody sues your business, they're suing the trust, not you personally. And because you no longer own the assets personally, you're not personally liable for business debts or lawsuits anymore either. At the same time, because the trust can defer passive income, you start using legal income conversion strategies. For example, let's say you have a real estate business. Instead of operating directly as an LLC or S-Corp, you structure an LLC joint venture where the trust becomes the limited partner. The business profits are distributed into the trust as passive income, not active salary income that's legally deferred inside the trust, where it can be used to fund life insurance, purchase additional assets, or cover trust expenses without triggering income tax events. And what about those trust expenses? That's another huge advantage of this structure. Legitimate trust expenses include things like legal fees, accounting fees, education costs for beneficiaries, even certain travel and asset management costs, as long as they are properly documented. And for the benefit of the trust, the trustee uses their discretionary power to manage these expenses, allowing money to leave the trust legally without triggering taxable income distributions. Now, some people will ask, well, how do I get personal spending money if I don't technically own anything and my trust controls the assets? Great question. And this is where the demand note strategy comes in. When you initially transfer your assets into the trust, you're technically selling them to the trust. In exchange, the trust issues you a promissory note or demand note, which is recorded as a debt owed to you. You can then draw down against that debt over time for personal spending needs. And because you're being repaid a debt, you're not receiving taxable income. You're simply collecting back what you are legally owed. This allows you to fund personal expenses without triggering taxable distributions. This demand note becomes your private bank account inside the trust structure. It's one of the most advanced but fully legal methods of managing personal liquidity while keeping the asset base fully protected inside the trust corpus. Now let's talk about why most attorneys and CPAs don't fully understand this structure. The vast majority of legal professionals are trained in statutory law, which governs corporations, LLCs, nonprofits, and other government-created entities. They are not taught contract law and common law structures like these non-grantor discretionary trusts, because these are private trust contracts that operate outside the statutory system. They were not created by government. They were created by private contract law, which is fully legal under Supreme Court precedent, but completely foreign to most attorneys' education. This is why most professionals will discourage you from using this structure, not because it's illegal, but because they simply don't understand how it works or they're afraid of what they don't fully grasp. That's why it's crucial to work with teams that specialize in this exact structure, who understand the legal framework and can provide ongoing management education and accounting services specifically for this type of trust entity. One of the most important things you will need is an accountant or CPA that understands how to file Form 1041, which is the tax return required for fiduciary trusts. Most standard tax preparers have no experience with this form or with trust accounting. You need a team who has spent years building relationships with banks, insurance carriers, and legal professionals to properly implement and maintain these structures. Now let's bring this full circle. When you use this trust in combination with whole life insurance policies, you create a permanent wealth compounding machine. Every dollar that flows into the trust gets leveraged for asset purchases, income deferral, insurance funding, tax planning, and long-term legacy building. Every death benefit payout replenishes the trust corpus, grows the family estate, and resets the process for the next generation. This is why families who started using these structures 50, 60, 100 years ago have built dynasties that will never run out of money, while most people struggle paycheck to paycheck and lose most of their wealth to taxes, lawsuits, and government regulation because they never understood how the game was really played. If you're serious about learning how to build a system like this for your family, for your business, for your long-term security, then contact the network directly on Discord, because this is not something you should be trying to piece together from YouTube videos or random internet articles. There's too much misinformation out there, and you need a real team who actually understands how to structure, operate, and manage these trusts properly over time. Inside the mentorship, we break down how to properly structure these trusts, how to legally defer income, how to fund life insurance, how to structure demand notes, how to transfer your existing businesses, real estate, and assets into the trust without triggering unnecessary taxable events. We walk you through how the trustee operates, how to document trust expenses, and how to build a true family office model that can manage your estate for generations to come. This is exactly how the elite operate, and it's available to you if you're willing to learn and execute. Again, this video is for educational purposes only, and if you want to go deeper, contact the network directly on Discord. We'll walk you through the real strategies and make sure your structure is built the right way so you can finally start operating like the banks do, like the elite do, and like the ultra wealthy have been doing for generations. That's it for today's video. See you guys in the next one.